recipes for technical trading success in Cook's Kitchen.
How did software get back in the stratosphere again? And what these valuations are crazy, but we're going to figure out why in this presentation today. I just did a presentation for some of the research folks at Zacks, and I want to share some of it with you all here. Last year, I started calling the entire software industry the Stratosphere because of what was happening with valuations, where companies were trading at 20, 30, 40 times sales. Well, things just went cumulonimbus on planet COVID here, and I'm going to try and explain why. Going back to last summer, July of 2019, here were the four major catalysts I identified why investors were paying over 20 times sales for some of these companies. First of all, software was immune to the tariff battles. It's part of a tech super cycle where, and this is, you can do the math here. I've been talking about this for 3 years. Productivity is much higher for companies and individuals while inflation stays tame. And then software is the brains of innovation, obviously. It can shrink and manipulate and enhance time and space. And then the industry lives in its own stratosphere based on the rule of 40. And the rule of 40 is simply software is very interesting and investable when you have revenue growth over 40%. But if you don't have revenue growth over 40%, hey, we can make up for it with a decent profit margin. But get us to that 40% number, some combination of revenue growth and profit growth or profit margin. So what happened in this May coming out of the coronavirus crash? The SaaS pure play companies, and we're not talking about Microsoft or Google here. We're just talking about the pure plays. So Adobe, CRM, Square, Workday, Now, Shop, Viva. 50 of these companies crossed 1 trillion in aggregate market cap in May for the first time ever. I'm showing you 35 of the tickers here. Obviously, you can stop this and take a closer look. So let's go back to give you some reference to that 1 trillion. Is that good or bad? Here's where we were in July of 2019. We were only, that same basket of 50 SaaS pure plays was only at 700 billion in aggregate market cap. And that was from KeyBank, who was looking at the growth metrics, average revenue growth of 36%. And again, not including the software giants. So let me tell you how I fumbled the trade of a lifetime coming out of the coronavirus crash. First of all, I was diving into software big time last summer, or starting in April. I wrote my first piece on the Stratosphere and how it was getting a free pass at valuation gorge back in April 2019. Then in early June, Salesforce buys Tableau for $15 billion. Basically threw down against Microsoft and Google by grabbing data. Then I became very interested in a company called Alteryx for like a data engine for mining and modeling dark data, and wrote some pieces on that. Zacks Confidential, that's what ZC is. Talked about the rule of 40 a couple of times and did a thing on dark data. I own both. By the end of June, I owned both Alteryx and Splunk. But let me just share one of these pieces. So here was let's see, this was my April 2019 piece, and I just want to show why NVIDIA is part of this too, driving this, because NVIDIA has the software hardware stack that they call CUDA, and CUDA stands for Compute Unified Device Architecture. And this sort of reinvented Moore's law with massively parallel architectures and just the speed of processing. I mean, fitting 21 billion transistors in the size of a shoebox, and then stacking 6 of those in a DGX supercomputer that any corporation could buy to do deep data mining and possibly deep learning. So I was looking at a bunch of companies back then. I said you had to be looking at all these software companies, across payments, the net, applications, security, e-commerce. And, so I was trying to be in it. And then this is one graphic that really stood out to me. This was from KeyBank too, back in 2019, was that how fast were revenues going to grow for some of these SaaS companies? I mean, they say it took SaaS, which was a cottage industry, that took 14 years to get the first 100 billion in revenues, but that the next 100 billion was going to come really quick, like in 2.5 years, and 2.5 times that by 2023. So this was the graphic that sort of stuck in my mind and made me a buyer of software. And you could look at anything from Statista too. On here's the video I did on software valuations and the Rule of 40. If you look at anything you could pull up on Statista, this sort of the projected revenue growth, was just phenomenal. I can't get this one lined up, but this is showing by 2022 we're going to have we're going to hit 275 billion in revenue growth in big data analytics and software. All right, so it was not easy to stay in those software stocks. It was not easy at all, especially during the meltdown in March and April. And we can look back in hindsight. So here's my hindsight view. What drove this? Obviously, the migration to the cloud and digital transformation were forced to accelerate. And in the remote economy, even investors sort of had to reset. We just had an economic asteroid hit, caused disruption for investors too, and they just followed corporations, that were basically ascending to the cloud. That meant valuation models got bumped to growth at any price. And the F troop helps a little bit. The F troop is obviously the Federal Reserve and fiscal stimulus, creating liquidity. And it's still true that portfolio managers have to buy. Money's coming in. They can't sit on cash. They got to put it to work. They got to compete with the index and each other. What did this do? It created a vicious FOMO chase in software. As of July, right now, 2020, those 50 SaaS pure plays I showed you hit 1.27 trillion, bigger than Google. All right. So, okay, here's a better look at software spend. And I mean, the last Statista graph I showed you was looking at projected 275 billion in big data analytics software by 2022. Well, here's another one, and how you search on Statista can matter, but this is how they labeled this graph that enterprise software IT spending has already eclipsed 450 billion. So this is what's driving the growth here. So just looking at some of these companies, DocuSign, you could have picked it up for $90 during the crisis, trading 25 times sales. Here's Square, finally trading a reasonable valuation, I think, of 9 times sales. It was dirt cheap at 4.5, 5 times sales, and nobody wanted it. Wall Street hated it. Here's an example. I did Square as the bear of the day because their estimates were going down. Even in May, after a fairly decent report, UBS downgrades to sell, BofA downgrades Square to underperform. The stock is back above 70. They were just so wrong. And this, if you search for this article I wrote on July 10th on Square, I said this, Square was Jamie Dimon's favorite mistake because he said they did everything we should have done. And that was, to me, that was a cue to stay long Square because of that innovation, that ecosystem. I call them the Apple of fintech because they knew how to create an ecosystem, not for selling hardware, but for bringing people in and giving them all the tools they needed in small business. All right, here's from ZRS, a comparison valuation chart. Just looking at some of these, here's Zoom. Why can Zoom trade for 37 times sales? Because of this growth. Everybody's piling in, buying subscriptions to Zoom. And if they can maintain, the annual recurring revenue, the ARR, and the net retention, then they're golden. I mean, they just came off 170% year-over-year quarter, Q1. Q2 looks like it's going to be 240%, and that's why they're paying 37 times sales for Zoom. It's incredible, but true. All right, Shopify, paying 46 times sales. But, for them to do 37% growth this year, this quarter is going to be 38%. That means they just came off a monster quarter that was over 50% growth. So that's why investors, and Shopify is a unique platform. I mean, it's considered the little Amazon, so to speak. So that's why investors are going to pay 40 times sales. There's Twilio. We're going to talk more about Twilio coming up here in a minute. Only trading 21 times sales. And again, this growth, if they're going to do 33% this quarter, and that's going to slow down, they just came off another monster quarter too. I think they had a 40 or 50% quarter in Q1, and they're doing 33% sales growth this quarter. That's why they're paying over 20 times sales for it. Viva, the software magician focused on biopharma, providing systems that are so important for biopharma to get through FDA trials, et cetera. Over 26 times sales. That was one I let go too early. Here's Alteryx, my favorite little data engine miner modeler. Bit of a hiccup in this year's revenue growth, but coming back strong. And their customers love them. They've got Audi, Barclays, Pfizer, and once the data scientist and even the amateur data scientist at a company uses the platform and realizes what they can do, they don't ever want to switch. So even if Microsoft or Google came out with a competing data engine platform, they're not going to switch. They're not switching to Splunk. They're staying with Alteryx because they love what the platform does for them with their internal data and any research they have to do on the outside. There's Team, a little cheaper. Datadog was a rocket. Datadog's trading 39 times, but look at that growth. 55% revenue growth this year. That's why they're paying 39 times for it. I'm not saying you should pay 39 times for Datadog, but if you get a dip and you can pay 30 times for it, you should buy it. All right, here's what the CEO of Shopify said recently. Hey, we're going to keep our offices closed as far as we can tell and just rework things because office centricity is over. All right, so I find all the, figured out all this stuff in hindsight. I had my basic ideas a year ago about why I wanted to be long everything in software. And then I fumbled the ball in March and April and didn't hang on to things like Alteryx and Square. We took 50% gains out of Alteryx again, but I missed keeping the trade desk at 200. So I'm learning all this stuff in hindsight about the rush. And now here's another data point that stood out. Last week, July 15th, Twilio publishes a study. And their study said that the pandemic accelerated digital transformation by 6 years. Okay, where did they get that number? Well, they got it because they did a really decent survey. You can look up the press release, obviously, from Twilio and get the details. A few of the highlights. 97% of enterprise decision makers believe the pandemic sped up their company's digital transformation. And so they've got all these stats here. But it was a really short survey. It was a 5-minute online survey, so obviously they got more respondents. 2,569 enterprise decision makers, 200 to 300 across all these countries: Australia, France, Germany, Italy, Japan, Singapore, Spain, the US, and the United Kingdom. And so let me go to the money shot here. Here's how they came up with COVID accelerated DX by 6 years. 43% of respondents said it accelerated their digital transformation by 1 to 4 years. 27% said 5 to 9 years, and almost 20% said over a decade. These are people who are either panicking that they had to move everything to the cloud and buy 10 new software programs for their employees to operate. Whether they were panicking or not. And the fact is, it happened, and the pandemic forced accelerated digital transformation, and so that's why you're seeing, upward revenue growth for so many SaaS companies, and I just see it continuing. So you want to buy the dips in software as per usual, and stick with Cooker if you want to know which software companies to buy at what levels. All right, thanks for joining me in the kitchen.